If you're following the space where traditional finance, what everyone calls TradFi, is colliding with the really dynamic world of DeFi, you are seeing one topic everywhere right now.
Everywhere. Real-world assets, RWAs.
Exactly. And this isn't just hype anymore. I mean, we are talking about institutional giants, BlackRock moving into this space. They're tokenizing everything from U.S. Treasuries to fractional real estate funds.
It feels like a pivotal moment, doesn't it? It's where blockchain technology, which for so long has felt like it's in its own little digital universe, is finally trying to build a reliable, compliant bridge to the enormous value that's locked up in physical, tangible wealth.
Right. And for you listening, whether you're just curious or you're a financial professional prepping for tomorrow's meeting, the question isn't if this is happening anymore.
No, the question is how does it work and what are the profound implications here?
That's our mission today. We're going to do a rigorous deep dive into the source material that explains the pretty complex foundations of this whole movement. We're not interested in just the high-level summary. We want the mechanics. We need to unpack what RWAs are, sure, but also the legal architecture behind them, why institutions see them as the next huge growth area, and, this is critical, the very real regulatory and tech challenges that are standing in the way of mass adoption.
And by the time we're done with this deep dive, you should have a really thorough, nuanced understanding of how tokenization is designed to fundamentally change how we verify ownership, how capital moves, and how assets are traded globally. This whole transition, it's one of the biggest structural shifts in finance this century. Right. We're going to explore the pieces of that bridge being built one by one.
Okay, so let's unpack this and maybe move past the simple definitions right away. An RWA, a real-world asset, is, well, it's anything of measurable value that exists outside of a native blockchain. A skyscraper, an ounce of gold, a government bond, simple.
Right. But they're governed by traditional legal systems. They have centralized title registries, physical paper deeds, and they are stuck with all the slow, bureaucratic friction of the existing financial system. These assets have huge value, but they're so expensive and complex to transfer.
So the key mechanism here is tokenization. This is the process of creating a secure, programmable digital representation of that real-world asset on a blockchain. We hear the term digital twin a lot.
Yeah, and digital twin is a useful phrase, but it maybe doesn't capture the legal gravity of it all. This isn't just a copy of the asset, it's meant to be a legal claim on it.
And this is where the complexity starts, right?
This is exactly where we need to focus. For a token to actually hold value, it can't just be some digital record. It has to be legally enforceable. That's the difference between a picture of a house and the actual deed to the house.
Okay, so how do they do that? How do you make it legally enforceable?
To get that crucial legal link, pretty much all institutional-grade RWA tokenization relies on a very specific legal structure. It's called a special purpose vehicle, or an SPV.
That's a critical detail. Okay, tell us more about the SPV. Why is that so essential?
An SPV is basically a legally separate, ring-fenced company or a trust that's set up for one reason and one reason only, to hold the underlying asset. So let's take a piece of commercial real estate. The SPV is created, and it legally owns that physical building. Then the SPV is the entity that issues the digital tokens on the blockchain. So the token you hold represents an ownership share, or maybe an economic interest, in the SPV, which in turn is the legal owner of the physical asset.
So if I'm an investor, I'm not buying a token that is the building. I'm buying a token that represents a fractional share of the legal entity that holds the building. It creates a kind of buffer.
Precisely. And that structure solves a few immediate problems. First, it isolates the asset from the risks of whoever issued it originally. If their main company goes bankrupt, the asset in the SPV is protected. And second, and this is crucial for you to understand, the SPV's legal jurisdiction dictates how the asset is governed. This helps satisfy regulators who are, pretty wary of purely decentralized legal claims. The legal basis is still rooted in traditional, recognizable corporate law, not just code.
That brings us right to the role of the smart contract in all this. So if the SPV is the legal rudder, the smart contract is the operational engine.
That's a great way to put it. The smart contract is like the automated rule book and the deed all rolled into one. It executes all the conditions that are normally handled by lawyers and escrow agents. So in our real estate example, the smart contract defines how many tokens exist, who owns which ones, and what percentage of the dividends, say rental income, each token is entitled to get.
And it handles the transfer of ownership itself. So if I sell my token to you, the smart contract instantly updates the ownership registry on the blockchain, And at the same time, it could, manage the distribution of any rent that's accrued to that token.
It's the automation of trust and settlement. And this is where the core promise really is. Instead of a paper deed that has to be tracked and verified by some centralized clearinghouse, you hold a digital token on an immutable ledger. This radical efficiency just removes layers of middlemen, it dramatically shortens settlement times, and in theory, it reduces the cost of transfer.
So the ownership verification becomes instantaneous and public. It transforms a slow, expensive asset transfer into a 247 digital transaction.
Exactly.
Okay, so to put it all together, if the token is properly structured through an SPV and it's governed by a smart contract, then the person holding that token has an enforceable claim verified instantly by the blockchain to their share of the asset's value or its cash flows. And all of that is legally protected by the traditional laws where the SPV is based.
Yes. That distinction between the digital verification layer and the real-world legal layer is absolutely essential.
It seems like that's the whole game. The tech efficiency of the blockchain is only valuable if that legal bridge to the physical asset is rock solid.
If that legal mechanism fails, the token is just data. It's worthless. So this foundational understanding, SBV plus smart contract, that's the prerequisite for discussing any of the real-world impact.
Now that we have that legal and technical foundation set, the SPV structure and the smart contract engine, let's make this concept really tangible. Let's focus on some specific, massive asset classes. And we want to show you, listening, how tokenization actually functions to, lower the financial bar and create some genuine inclusion.
And we have to start with the poster child for illiquidity and high barriers to entry. Real estate, commercial real estate it's pretty much confined to institutions and ultra high net worth individuals. You might see an incredible investment opportunity in a, let's say, €100 million office tower in Frankfurt, but obviously that's out of reach for almost everyone.
This is where fractionalization, which is enabled by tokenization, becomes this powerful inclusion engine. So let's go back to our Frankfurt office tower, which is held by that SPV. That SPV issues, say, 100,000 tokens. All of a sudden, instead of needing €100 million, an investor can get in for the cost of one token, maybe €1,000, representing a tiny fraction of that building.
This is the democratization of exclusive markets in practice.
Yeah.
But the complexity of fractionalizing real estate is often kind of glossed over. It's not just about sharing the initial cost. The smart contract now has to manage ongoing liabilities and rights. Who is responsible for, say, proportional repairs to the roof?
Right.
How are tenants dealt with? How is the rental income, which comes in as, fiat currency off-chain, how is that converted and distributed on-chain to thousands of token holders automatically?
That's a great point. That transition of off-chain cash flow onto the blockchain is a huge technical challenge. It's often solved by designated payment agents who work within the SPV structure. They feed the fiat currency into the smart contract system, which then automates the proportional distribution, probably using stablecoins or something similar.
And the efficiency gain is just astronomical compared to traditional property management, which would require, bespoke dividend payments to hundreds of different limited partners. It's a nightmare.
Okay, let's move beyond physical property. Let's look at cultural assets. Fine art, rare collectibles. These assets are often incredible stores of value, but they are so inaccessible. They require specialized knowledge, high insurance, secure storage, often just hidden away in vaults.
A high-value asset, like an iconic piece of modern art, can be tokenized. And while this does allow thousands of people to collectively own pieces of it, the RWA conversation here gets really fascinating because the physical logistics, they don't disappear. Someone still has to insure the Picasso, someone has to handle the environmental controls in the vault.
So the token holder doesn't have to worry about the insurance bill directly, but they have to trust the custodian who is managing the physical piece of art.
Exactly. In this model, the token isn't just an ownership share, it's a claim on a service-secure storage, insurance, maintenance, all paid for, proportionally, through the asset's capital structure. Tokenization is only successful if that custodian's performance is impeccable and legally binding. It just reinforces that foundational trust issue we'll have to explore later.
Okay, let's shift to what is right now the hottest, most institutionally embraced segment of all this. Tokenized U.S. Treasuries and government bonds. These are, traditionally seen as high-quality, low-risk, secured debt. They're essential for any institutional portfolio.
But historically, for a retail investor, getting direct access to the yield from these instruments was cumbersome. You had specific brokerage accounts, minimum balances, and often you were just buying mutual funds that held the treasuries indirectly. So you're paying fees and not getting the most direct, efficient yield.
Tokenization completely transforms this access. It creates a secure yield bridge for the entire decentralized finance ecosystem. Let's look at a concrete example. Companies like Franklin Templeton and, critically, BlackRock have launched tokenized funds. BlackRock's BUIDL fund, for instance, is a money market fund that holds U.S. Treasuries and repos.
The mechanism is, on the surface, elegant in its simplicity, but it's highly complex legally. So BlackRock registers the fund, it invests the capital into high-quality government debt, and then it issues digital tokens on a compliant blockchain like Ethereum or maybe a permission chain.
So when you buy BIDL token, you're essentially investing in a highly secure, regulated financial instrument.
Yes, and the yield that's accrued by the treasuries in that fund is then converted into new tokens or some other value accrual mechanism, and it's deposited directly into the holder's wallet via the smart contract.
What's so fascinating here is that this is not decentralized in the pure crypto sense, right? I mean, BlackRock is still the centralized issuer and administrator.
Oh, absolutely. But they're using the blockchain purely for efficiency. They are leveraging the blockchain's 247 instant settlement feature to offer a product that traditional clearinghouses just can't match in speed or cost.
And this has massive implications for DeFi. Projects like Ondo Finance have specialized in allowing DeFi users to access this tokenized treasury yield directly.
They do. They aggregate capital from the decentralized ecosystem and then use an institutional partner to purchase BUIDL or similar tokens. They're bringing that safe, verifiable, regulated yield from the traditional world right into the volatile DeFi ecosystem. This provides DeFi with a reliable, low volatility collateral and savings mechanism, something it has desperately lacked.
So if we synthesize this section, the key takeaway is that RWAs are really an engine of inclusion. They achieve this not just by splitting up high-value assets into smaller pieces, but by collapsing the geographical and operational barriers needed to access them. Whether it's real estate, art, or the world's safest government debt, tokenization fundamentally redistributes financial opportunity to a much broader base of everyday global investors.
We get the definitions, we've walked through the examples. Now, we really need to focus on those structural, almost existential benefits that are attracting trillions of dollars of institutional capital. This goes way beyond just being a hot topic. This is a fundamental re-engineering of the architecture of global wealth transfer.
And as we said earlier, the single biggest driver of this entire narrative is liquidity. This is the core inefficiency of traditional finance that tokenization is explicitly designed to solve. Assets like physical property, private equity stakes, or corporate loans are static. They just sit on a balance sheet and they can't be easily moved or repurposed.
The contrast with traditional settlement is, it's stark. If you sell a public stock today, it often settles in T+2 or T+3. That means the cash isn't officially yours and the security isn't officially the buyer's for 2 or 3 days. For real estate or private assets, that process takes weeks or even months. It creates massive friction and requires so much logged capital.
And this is where it gets really interesting when we talk about capital efficiency. When an asset is illiquid, it carries what they call a liquidity discount. Investors demand a lower price because they know they can't sell it quickly.
Exactly.
By transforming that illiquid static asset into a divisible, instantly transferable digital security via a smart contract, you dramatically shrink the settlement timeline to almost zero.
This ability to move tokens instantly, 247, 365 days a year, across any border, it eliminates that liquidity discount and it unlocks massive amounts of trapped capital. For a large institution, this means they can manage collateral far more efficiently. If they need to rebalance a portfolio, they don't wait 3 days for a wire to clear. They just execute the transaction instantly.
That improvement in capital velocity alone is a multi-trillion-dollar incentive for traditional finance to adopt this.
It's huge.
Let's move to the second pillar of the promise: transparency and immutability. You mentioned before that records on a blockchain can't be altered once they're validated. But why is that so revolutionary compared to what we have now? I mean, doesn't a county deed registry work fine?
It works fine, but it's centralized, it's siloed, and it's opaque. Traditional asset ownership is recorded in, countless different centralized ledgers, banks, land registries, brokerage accounts, and all of them require you to trust the administrator of that ledger. This creates enormous counterparty risk. You have to trust the intermediary.
And it creates a massive administrative burden. I mean, think about the due diligence you need to do to verify the chain of title for a piece of property over 50 years. You're literally digging through centralized archives and paper records. It's expensive, and it's prone to error or even fraud.
The blockchain solves this by providing a single, unified, public, immutable record. The entire transaction history, the precise chain of ownership, and the current legal claim are all secured on a transparent ledger that's accessible to anyone with an internet connection. This auditability is revolutionary. It dramatically reduces the cost and time for due diligence because the history is verifiable and pristine.
I would argue that's maybe the most profound benefit for global commerce. If I know that the history of an asset is verifiably true, it reduces the risk premium I demand as a buyer. This increased transparency builds trust not through reliance on some central intermediary, but through cryptographic proof.
Absolutely. And the third critical factor, which we touched on, is enhanced global accessibility. But we have to expand the scope here. We're not just talking about lowering the financial bar through fractionalization. We're talking about eliminating geographic and bureaucratic hurdles.
So consider an asset like private credit. These are loans made to small and medium-sized businesses. Historically, that's only been available to large institutional investors in the local market where the business is.
Right. And those opportunities are difficult, if not impossible, for a fund in Singapore to access if the underlying business is in, say, Brazil.
Tokenization provides the standard operating system for this. If that private credit asset is tokenized, wrapped in an SPV governed by a smart contract, it is instantly tradable to any compliant investor anywhere in the world. This just blows the doors open on the pool of capital available for those private assets, which could potentially lower the cost of borrowing for the businesses themselves.
Right.
So we see the trifecta that's driving this massive shift. Instantaneous global liquidity unlocked by 247 settlement, unprecedented transparency guaranteed by immutable public records, and expanded accessibility both financially and geographically. This combination fundamentally addresses the core friction points of the old financial system.
It shifts the whole infrastructure of wealth from a slow, opaque, geographically constrained model to a real-time, transparent global system. And that is why institutions view RWAs not as an experiment, but as essential future infrastructure.
That summary of the revolutionary promise is, well, it's incredibly compelling. It almost sounds like financial utopia. But the reality is that the collision between the physical world of lawyers and deeds and the digital world of smart contracts and code is creating some serious ongoing friction. This transition is not smooth, and we need to spend some real time on the obstacles preventing widespread adoption.
The most formidable challenge, the one that makes large institutions really pause, is the regulatory quagmire. I mean, blockchain technology is moving so much faster than legislative bodies can respond, and that lack of legal clarity creates prohibitive risk.
The central legal question really is one of classification. If I tokenize a piece of corporate debt, is the resulting token a security? In the United States, that brings it under the very strict purview of the Securities and Exchange Commission, the SEC, and the decades-old Howey test.
That's a crucial distinction. The Howey test is what determines if an asset qualifies as an investment contract, and therefore a security, which then requires really stringent registration and disclosure. If an RWA token is deemed a security, it means it has to be traded on registered exchanges. Only certain investors, like accredited investors, can buy it, and the issuer has to adhere to really complex compliance.
And many of the initial crypto projects intentionally tried to avoid that classification.
Right, but RWAs, by their very definition, represent investment contracts in tangible assets, so they pretty much walk right into it.
And the regulatory frameworks differ all over the world, which is a massive headache for a movement that's promising global accessibility. The European Union has tried to provide a comprehensive framework with MiCA the Markets in crypto assets regulation.
MiCA is significant because it aims to provide harmonization across the EU. It classifies tokens into different categories, including those linked to assets. And while this provides regulatory clarity, which is exactly what institutions crave, the U.S. approach is still fragmented and relies mostly on enforcement actions. That makes it really difficult for projects to proceed with any certainty.
So this global fragmentation just stalls adoption because institutions can't easily launch a product that's compliant everywhere.
Exactly.
And this leads right to the question of permission versus permissionless systems. Traditional finance often doesn't want full, open decentralization for RWA trading because they need to enforce KYC-AML rules, know your customer, and anti-money laundering.
Precisely. If BlackRock issues a tokenized fund, They legally cannot allow a known bad actor to hold that token. So many institutional RWA solutions use permission blockchains where only verified whitelisted users are allowed to transact. This maintains regulatory compliance, but it fundamentally sacrifices that core decentralized permissionless ethos of many crypto purists.
It shows that for RWAs to succeed, compliance often trumps decentralization.
It has to at this stage.
Let's move on to the trust deficit. This critical need for the digital twin to accurately and legally reflect the physical asset. If the token is perfect, but the legal link to the deed breaks, the whole system just fails.
The trust deficit really highlights the reliance on centralized intermediaries, even in a supposedly decentralized system. The custodians who secure the physical deed or the bond certificate are paramount. They have to execute the legal contracts associated with the token.
Yeah.
If that physical property asset is seized or damaged, or the underlying legal agreement is challenged in court, the token instantly loses its value.
So while the blockchain verifies the digital ownership, it's an off-chain, centralized, legally binding contract that validates the physical claim. And who enforces that legal contract? If the smart contract is automatically distributing rental income, but the tenant stops paying rent,
Right.
the token holders need a legal representative, the SPV, to pursue litigation in the traditional court system. The code can't do that.
And this creates an absolute dependency on oracles. Oracles are services that feed verifiable, real-world data onto the blockchain. For an RWA token, oracles are necessary to confirm things like the current valuation of the asset, whether the property is still standing, or if the underlying bonds have defaulted. The token has to be updated by a trusted off-chain feed. Otherwise, its digital value could be totally disconnected from physical reality.
So the security of the RWA model isn't just cryptographic. It's dependent on the integrity of that centralized legal structure, the SPV, the reliability of the custodian, and the accuracy of the decentralized data feed from the oracle. That is a fragile chain of custody that has to be protected.
Absolutely. And finally, we have to talk about the technological infrastructure constraints. We're talking about digitizing trillions of dollars of global wealth. The underlying technology has to be flawless in its performance and security.
And first, scalability is a major concern. If every major financial institution starts tokenizing their entire asset portfolio, the volume of transactions will just skyrocket. The network, whether it's Ethereum, Solana, or a private chain, it must be able to handle millions of transfers, settlements, and automated dividend payouts every day, and do it quickly and cheaply.
High gas fees or slow throughput are immediate deal breakers for TradFi institutions. They're used to seamless private networks.
Second, interoperability is non-negotiable for a truly global RWA market. Different asset classes and different institutions will choose different chains. BlackRock might use a permissioned version of Ethereum. A regional bank might use a customized enterprise chain. These siloed chains have to be able to communicate, allowing tokens to be moved or used as collateral across platforms.
If they can't talk to each other, the market stays fractured, and those liquidity gains we talked about are minimized.
And lastly, the continuous concern of security. While the immutability of the blockchain is powerful, smart contracts are code. And code can have bugs, exploits, hacking, flaws in the governance logic. These pose catastrophic risks, especially when they're governing multi-billion-dollar assets.
The technological hurdle isn't just about building a blockchain. It's about building a scalable, interoperable, and fully auditable governance layer. That smart contract that is entirely bug-free and can withstand state-level cyber threats. The sheer value represented by RWA tokens makes them the ultimate target. It demands constant technological refinement and the highest level of cryptographic assurance.
Despite the pretty daunting legal and technical obstacles we just laid out, the key takeaway from the source material is undeniable. The momentum behind RWAs is not only accelerating, it feels like it has already passed the point of no return. We're seeing real institutional conviction.
The evidence of that conviction is in the names we've already mentioned. When the largest asset manager in the world, BlackRock, and long-standing players like Franklin Templeton actually launch tokenized funds, it sends an undeniable signal that this technology is viewed not as experimental, but as essential infrastructure.
And that institutional endorsement is so crucial because it moves the narrative away from speculative crypto ventures and toward regulatory, compliant, robust financial products. I mean, BlackRock's choice to build a tokenized product on a public blockchain, even if it is a permissioned one, that signifies their belief in the efficiency gains of the tech.
And that efficiency gain is driven by their desire for near-instant settlement. They are using the blockchain to eliminate the time and cost that's associated with traditional clearing and reconciliation. It simplifies the reporting and distribution of yield dramatically, making their existing processes cheaper and faster. And that translates into a competitive advantage.
This institutional push is actively creating that functional and robust bridge between traditional finance and DeFi that we were talking about earlier.
For years, DeFi really struggled because it operated within this limited universe of native crypto assets, which led to extreme volatility. The integration of tokenized treasuries and bonds, these low-risk assets from the traditional world, it provides a desperately needed ballast. This is high-quality collateral that decentralized applications can actually trust.
It fundamentally alters the utility of DeFi. Decentralized lending protocols, for example, can now accept tokenized BUIDL or similar funds as collateral. This brings stability and verifiable traditional yield opportunities right into the heart of the decentralized ecosystem.
And that makes DeFi far more appealing to professional and institutional investors who require predictable, regulated returns.
So this integration means DeFi is becoming a legitimate venue for managing real-world high-value collateral. It's moving beyond just speculative trading and toward genuine financial services.
It's the evolution of decentralized finance from a siloed movement into a truly interconnected global financial layer.
And this convergence is why that bold prediction from the sources seems increasingly likely. RWAs could very well be the single biggest driver of widespread blockchain adoption in the next decade. And why? Because they offer the most powerful, tangible use case we've seen yet.
They transform the blockchain from an interesting technology for niche digital currencies into the essential infrastructure for global wealth verification and transfer. By solving the core problems of illiquidity and opacity in established assets, RWAs create a commercially irresistible argument for institutions to fully transition. The physical and digital worlds are being merged at the foundational level of finance.
We've spent a lot of time dissecting the mechanics, the revolutionary promise, and the formidable obstacles facing this new era of finance. Let's distill the core impact of RWAs one last time. This is about leveraging blockchain technology to make real-world assets, the physical wealth that underpins our global economy, profoundly more accessible, drastically more liquid, and vastly more transparent.
The future of global investment is being redefined by these technological and legal innovations. The question for you, the learner, is really how quickly you can integrate this understanding into your own professional outlook.
Based on everything we've covered, the promise of instant 24/7 trading, but also the complexity of the legal SPV and the regulatory maze, the provocative thought we want to leave you with is this. Given the current state of the technology, the custody, and the regulation, what percentage of your investment portfolio would you currently feel comfortable allocating to a tokenized building or a tokenized bond? What specific additional safeguard would move that needle for you?
We'd encourage you to continue to explore not just the big names, but the smaller, specialized platforms that are solving those critical pain points we discussed. The custody solutions, the Oracle providers, and the legal firms that are constructing those vital SPV bridges. The devil is in the details, and that's where the true opportunity lies.
And finally, to leave you with a concrete challenge for further musing after this deep dive, build on the asset classes we covered today: real estate, art, and treasuries. Think about a market that is currently completely illiquid, siloed, and opaque.
What real-world asset, beyond the examples we discussed today, would you personally want to see tokenized first if all the regulatory challenges were suddenly solved tomorrow? Maybe fractional ownership of private equity funds, which are entirely locked up for years? Or maybe the ability to easily trade fractional rights to intellectual property, like music royalties.
The potential application is truly boundless. Explore that question, stay informed, and stay curious about the next phase of this financial revolution.
1, 2,